today is probably the day that everyone comes with notes and pens and attention, because we are not talking about glamour and glitz. We are talking about taxes. But there are still a lot of people in the room, which is encouraging to see, because all of us, I don't want to speak for Nav, our speaker, and I don't want to speak for some of the other more analytical folks in the room, but I'll say most of us probably do our taxes because we need to, not because we want to. And most of us probably do not enjoy the process of doing our taxes. So the fact that I see so many faces in the room, both new and old, means that you're not here out of a love for taxes. You're here out of a love for optimizing your business to get the most for you and your family while still not going to jail. So I'm thankful that everyone's here. I think we're gonna have some really good stuff for everyone. So without further ado, I wanna invite our speaker here up. We've got Nav from Equity CPA. And we're going fireside chat today, guys. We're gonna grab a seat and we're gonna talk through some questions. So before we get started, I'll hand the mic off to Nav and just let him share maybe a little bit about you, a little bit about your story and how you got started in this business, and put a face to a name.
Yeah, nice to meet everyone. I know we got to meet earlier today, but pretty much my wife and I in the back, we started our own tax firm out in January, and we're focused in real estate. And I've been doing taxes in the real estate field for about 3 to 4 years now. And so eventually I decided to do our own thing. It's called Equity CPA. So hopefully you guys enjoy this talk.
Yeah, thanks, Nav. So I'm guessing a lot of the questions are going to be around the big kind of heavy hitters, right? Short-term rental loophole is something we talk a lot about. Bonus depreciation and cost segregation is something we talk a lot about. Let's talk cost segregation actually first. Can you give us a little bit of an outline of what that is for those of us that aren't familiar? And then also to kind of back up to the 1,000-foot view, like who is it for, right? Why would we bother doing a cost segregation, and what would it actually help us achieve?
Yeah, so cost segregation, essentially, it allows you to break down your property into 5, 7, and 15-year asset classes. And the benefit of that is, so anything that's under 20 years, you're able to get bonus depreciation. So if you look at your depreciation schedule, a lot of the times the building is depreciated over 27 and a half years, or your commercial property 39 years, and you're not able to take bonus on that. So a cost segregation study will go in, or I guess an engineer will come to your property. They'll do whatever calculations they need to do, break your assets down to 5, 7, 15. He'll come back to us, and then we can take bonus. So I guess from a 1,000-foot view, essentially you're able to accumulate a lot of those losses up front. So instead of waiting 5, 7, 15, 27 and a half years to be able to take all the losses, you can get them right away. I think that's the biggest thing.
Yeah, one of the kind of core reasons that many of us invest in real estate is because of the difference between the present value of money and the future value of money, right? Which is just fancy economics talk for $1 today is worth, sorry, got it backwards. $1 today is worth more than $1 tomorrow for many reasons, right? Not just because we're all greedy and we want the money now, but also because of this pesky thing called inflation that is always in the background and sometimes comes to the foreground in years like the last couple of years. And one of the reasons that many of us get involved in real estate investing is because our rents will tend to go up over time, both because of inflation and because just increasing cost of living. Whereas our mortgage, assuming we don't refinance, tends to stay about the same. That's not always true, right? There's property taxes, there's insurance, some things that go up, but at least your monthly principal and interest payment stays the same. So the principle of getting a fixed cost and an increasing amount of revenue is core to what real estate investing is. And connected to that, if we can front load some of our savings, we can save money on our taxes and we can pocket more of our money sooner. So that regular depreciation schedule kind of goes out the window with cost segregation, and you can take all the benefits at once. What what kind of investor do you typically recommend cost segregation for? Is there a size of property? Is there income thresholds? Like, how do you know if cost segregation is for you?
Yeah, I think it just depends on the investor's goals at the end of the day. So if your goal is to sell the property in the next year or 2 years, I don't know if that's really worth it, just because the cost benefit analysis of you maybe spending $2,500, $5,000 on a cost segregation study, but then you're going to end up selling the property. I don't know if that's going to be worth it. Whereas if if you're going to keep the property for a good long period of time, then we can take a look at it at that point.
Is there a threshold of value for the property where like, oh, a really inexpensive property, it just doesn't make sense to do a cost segregation? Or is that not a good metric to use?
Yeah, I mean, I guess it all depends too. I think the best way to look at it is a lot of the times these engineers, they'll run a cost benefit analysis for you. So before you even do it, you can talk to them. They'll run some numbers and they'll say, hey, this is what it's going to cost us to do a cost segregation, and then these are the benefits. And at that point, the investor can make their own decision.
Yeah. What kind of ROI do you typically see on those? Let's say you are spending $2,500 for a cost segregation study. Do you typically see 3x that in tax savings, 4x? Is there a good rule of thumb?
Yeah, I guess conservatively speaking, it could be anywhere around 20%, but it could go anywhere from 30 to 35% too. It all depends on your building versus land value. Like for example, homes in California, the land value is much lower, is a lot higher than the building value. So the ROI on getting cost seg on that property is probably going to be less than the property you bought out in Alabama or something like that.
Got it. Because we're not depreciating the land, we're just depreciating the building and the components of the building.
Exactly.
So really the right question isn't what property value does it make sense at, it's what building value does it make sense at, right? Because the land could be $0 to $1 million, it won't make a difference. Yeah. Cost segregation is one of those things that has been around for, I don't know.
Forever.
Forever.
A long time.
We're all young, so we can say forever. One question I had was, we touched on selling the property, and you mentioned that maybe holding it for a while makes the cost segregation more advantageous. Let's say we do a cost segregation and then we do go to sell the property. What does that impact, and what happens to those depreciation?
Yeah, so essentially all that depreciation you take up front, you're going to have to pay depreciation recapture on that. And those aren't going to be taxed at capital gains rates. They're going to be taxed at ordinary income rates. So you might end up owing more in the long term. But that's where, tax planning comes into play. So if you do cost segregation, there are ways where we can hinder your tax liability in the future. Yeah.
Is there a way to avoid depreciation recapture? I'm thinking like 1031 exchange without avoid the recapture.
Yeah. So you can defer a lot of those gains, and that's what 1031 exchange is for. What I've also seen people do is it's called the lazy 1031 exchange. So essentially, let's say in one calendar year, you sell a property. Well, the goal is to buy a property, run a cost segregation, and then whatever the losses you've accumulated from that cost segregation, you'll use that to offset against the property that you sold. So you're not entitled to the same rules as a 1031 exchange, which the 45 days or whatever it is. The caveat here is you just need to do everything all in one calendar year.
Mm-hmm. Interesting. So you're getting hit with the taxes, but you're simultaneously hitting back with a big deduction to kind of counteract that tax burden. Interesting. Yeah. That's a huge problem in our market, is the requirements, the timeline for a 1031 exchange, right? If you can quickly find a high quality investment property in your market, it is a great tool. But if identifying a property in 45 days and then closing on it in 180, which is one of the reasons why you can tell 1031 exchanges are so antiquated, is because the identification window is a month and a half, and then they give you 6 months to close, as if we weren't closing deals in 18, 21 days here, as if closing was going to be the hurdle. that can be really huge. One of the things that I've seen happen with investors on 1031 exchanges, and Nav can correct me if I've got this wrong, but because there's a 45-day identification window and then a 180-day closing window, if you make a mistake or if you can't find a new property and you just don't identify a property, or all the properties you identify you don't manage to purchase, it's not like you get your money back at the 45-day mark. They actually hold it until you hit 180 days. Is there a way out of that, or is that always the case?
Yeah, I'm not sure.
You know, okay.
Yeah.
I've seen people miss identifying a property because they just can't find one, and then as if to add insult to injury, they are not only paying taxes on their gains, they also don't actually get their money until the end of the 180-day window. There might be a loophole for that, but I'm not aware of one. So 1031 exchanges are amazing, but you got to be careful.
Is cost segregation better or worse on your property or a little bit on private 80-year-old garage?
Is it better or worse on a newer property versus an older one, build age?
When did you buy the property?
Last January, a little over a year ago.
Then it might be worth it. So it's not dependent on the year the building was made. It depends on when you bought the property. So for example, if I did a cost segregation 10 years ago, I sold that same property to you, you can do another cost segregation and pretty much get the same sort of deductions that you're entitled to.
So it doesn't age of the July. Here and I just bought something last month. 2 months. Yeah, because the house was built.
Well, I guess a newer property would potentially have higher building value, so you've got more fodder for your cost seg. But
Exactly, like kind of like what Michael was saying, the time value of money. So if you've had a property for, let's say, 10 years and you do a cost aggregation, it might not be beneficial for you to do one right now. But if you just bought a property a year, 2 years, 6 months ago, whatever it is, you might have to look at it. It might be better to do it then.
Why is it better if you bought it last time?
Sorry, what was that?
Why is it better for you to study develop property to less?
So kind of like we were saying, like the time value of money. So for example, if you do a cost aggregation, you bought a property in January, you do a cost aggregation 10 years from now, the 5 to 7 year asset classes, they're already depreciated. So you're not going to get the same amount of benefits as if you were to do them today.
yeah, essentially you've got a cooler full of drinks at the party, and you're allowed to pull one out, every minute for the next 29 minutes. And you can just grab a whole bunch of them with cost segregation all at once and hand them out and kind of start it immediately. But if you're 10, 15 minutes into the party already and you've already worked through half the cooler, like it doesn't benefit you that much to grab the rest of it. That was a really bad analogy. Goodness gracious.
That was good.
Yeah, hearing.
Yeah, and Michael, you kind of touched on it earlier. It would be good to touch on the income thresholds and all that as well, right? Like the limits, right? In terms of like
Income thresholds.
Yeah, because we have a primary gain, like I do. You can investing into like your secondary trades, yeah, the limits to income and all that. We'll be good to kind of touch on that and the solution for that.
Yeah, I'll open it and then hand it off to Nav. It seems like, and if you're not too familiar with REP status or the short-term rental loophole, the depreciation is a benefit no matter what, because it is tax savings. But what taxes are you saving on is an important question. And the reason that people that are using the short-term rental loophole, which Nav can talk more about, or our real estate professionals love depreciation so much more, is because we aren't just using it to offset our rental income, we're also using it to offset our W-2 or self-employment income or flipping income or active income, right? And there's the income threshold question, and then there's also the question of how much money does your rental properties make versus how much money you make, and whether you can take those deductions.
Yeah, so essentially, I guess the big question here is, if you are a W-2 employee, a lot of the times you won't be able to qualify for reps. There's certain hurdles and things like that you have to go through. So what I've seen a lot of high net worth individuals do is they'll buy an Airbnb property, they'll run a cost segregation. Well, assuming you meet all the material participation tests, and then your property is rented out average of 7 days or less, you can run a cost segregation. So essentially, what that does is it'll move that rental property from it being passive into active. So when you do run a cost segregation, a lot of those losses you're able to offset against other W-2 income, business income, or whatever the case is.
Something has changed in your financial situation when you get excited about losing money, because it'll lower your tax burden, right? And that's the principle that we're talking about. The magic is that when we're talking about the value of your building, depreciation, it's not real money, right? It's what we call paper loss, right?
Yeah.
I look at Nav whenever I say something because I'm terrified of saying the wrong thing. And he's nodding at me so far, which is good. But that paper loss, so you're not actually losing real hard dollars to get that deduction. You're taking a paper loss on your taxes, and it's acting as if it's a real loss and offsetting your actual income. So before we get too deep on the weeds there, I think it would be helpful to talk a little bit about material participation, the short-term rental loophole that we're referencing, because for many people in the room, that is their route to playing this bonus depreciation tax game specifically to lower their active employment income, right? Because for most of us, real estate professional status, the other route is out of reach just because of how high that hurdle is. So let's talk about that.
Yeah, so the material participation, there's 7 tests, but there are 3 that I've seen that investors use most commonly. So the first one being you need to be actively involved at least 500 hours or more in your business. Second one being you have to be substantially involved. And what does substantially mean? That's a gray area, and we need documentations to prove all that and everything like that. So the third one being you need 100 hours or more than anyone else in the business. So if you're able to meet at least one of those 3, and the average day is 7 days, the average rental period is 7 days or less, the strategy here then becomes, well, now you've moved the real estate from passive to active, run a cost segregation. So let's say if you bought a property for $1 million, you run a cost segregation, you have $200,000 worth of losses, 20%, pretty conservative. You're able to use all of the losses against your active income, your W-2, commission, interest, whatever it is. And whatever you don't use, you can carry it forward to future years and offset future income. So that's the big loophole right there.
Is that carry forward rule true of regular depreciation? If I don't use all my regular 29.5-year depreciation, does that carry forward, or do I just lose it?
One more time?
The ability to carry your losses forward, is that true of other types of depreciation, or is that unique to cost segregations? Yeah.
Yeah, I mean, even if you don't run a cost segregation study, you're still depreciating, and those losses still get carried forward regardless if you use them or you don't use them.
Yeah. Makes sense.
Yeah, John.
So that's the question of that. If I hire a property manager, like Michael recommended, is that automatically passive, or is there a way around that?
For your short-term rentals specifically.
Yeah.
Yeah, that's going to be tough just because like I said, you need to be material. So one of the 7 tests and then the 3 that I mentioned, right? So if you hire a property manager and for you to substantiate, hey, I'm actually more involved than the property manager, it could get difficult. I'm not saying you can't do it, but it gets very, very difficult.
So you don't have any lab magic or anything?
No. No, nothing like that.
Also, it always comes down to audit this, right? It's not about what you're putting in the cash. It's about you're now playing roulette. What are you going to say when you get audited? That's where it comes down to. Are you going to have a story or not?
So what are the chances of getting audited?
I can't answer that question. We're handing the mic to Nav on that one. What are Aziz's percentage chance of getting audited specifically?
A lot of the times when, as a deduction, you'll write property manager. So if an auditor or an IRS person sees that, And there you go. Now you might be held liable.
Who has been audited or knows someone that's been audited? Not that many, actually. I can say it wasn't me. I didn't get audited. I have a family member that got audited. It was for giving money to charity, which is like, oh, particularly like it was some fancy footwork around a charitable donation that he got audited over. It took 3 years and dramatically impacted his faith in the U.S. government. I'll put it that way. It was not a pleasant experience. So the risk doesn't seem to be terribly high, but by percentage. But the risk isn't if it happens, like how miserable it'll make your life is pretty dramatic.
Also, I think the additional risk is once you get audited, your future audit risk also goes up. So that I think is kind of an additional risk we want to balance. Yeah, I know nothing. So I don't do that.
I have a question. So if you had, let's say you're running the short-term rental loophole, right, on a short-term rental, and you do a cost seg, but you also have long-term rentals, and they have a loss as well. Do those combine together, or can you talk a little bit about how that works?
Yeah, so if you're not actively involved in your long-term rentals,
Meaning you have rep status, or?
yeah, like if you have rep status. So essentially the way to look at it, there's 3 buckets of income. There's active, passive, and investment. So active, your typical W-2, passive, real estate, and then portfolio incomes, interest, dividends, and all that. So in order for you to move passive into active, you have to qualify as a short-term rental loophole or claim reps. And until you do that, that passive investment stays passive, regardless if you have passive income or passive losses.
But if you claim rep, then both asset classes, short-term and long-term, can.
Exactly. Yeah.
But if you're just materially participating on your short term, would it just be your short term rentals that are depreciated against your active income, or would it also turn your long term rentals into depreciable?
Yeah, that depends on the hours that you're using. So for example, for reps, there are certain hours that you can use for material participation and reps. Mm-hmm. So for example, brokering businesses, construction, fix and flips, and things like that. What hours that you can't use are like look researching properties or anything like that. So it really just comes down to the type of hours that you're using.
Is your RAP status applied to all your long-term rentals or just one or all of them? So even if you are just doing one RAP, the real estate question, you have property management on the other rentals, it applies to all of them then?
It can. It just depends because, so real estate professional, it essentially says if you have more than 750 hours and more than half your working time is in real estate, all of your rentals become active. All of them become active, yeah.
One interesting component is that you do have income on your rentals. And my CPA has told me before that my depreciation is helpful, but your rentals make too much money. So you're not able to do as much with it as you could. So there's kind of 2 sides to this, right? Like if you're really crushing it and you're buying really well, I don't know, maybe your depreciation savings are not as high without doing the cost segregation, right? Because you're taking depreciation every year no matter what. And sometimes you still take a loss, even without cost segregation. But sometimes I've seen people make a lot of, they're just doing really well with their rentals and there's not that loss otherwise. Yeah.
Just something that came into my mind when you said that. Have you ever heard of somebody owning real estate in splitting it between the 2 spouses instead of doing it jointly, all of it, owning it all jointly or filing jointly? Is that like a loophole or something that you've heard of before, or filing for that?
No.
Or am I thinking of that wrong?
Yeah, so I'm trying to get this right. So let's say if you and your wife own one building and then she owns another one. For the material participation, yes, you can use some of those hours together, but not, it depends what those hours are. And even, yeah, you can use them, it just depends what those hours are. I guess I could say that.
Do we have other short-term rental material participation questions? Yeah, Sweta.
So if we buy a short-term rental and we do cost segregation analysis, that tax benefit is going to be only for that year, right?
Until you use it up, it sounds like, right? So if you use it up that year, then it's just for that year. If you don't use it up, you can roll it. Is there a deadline? How many years? Or you just forever?
Forever until you use it.
But is it generally how much is it? So usually people roll it up or do they use it all at once?
The general concept of doing a cost segregation is you want to be able to use it right now. So kind of like how we were saying, like the time value of money, the deductions you take right now is going to benefit you more than trying to take it maybe 5 or wherever. So
Yeah, so and that's more of a question of how much money you make more than anything else, right? How big is your tax burden, right? Because you can keep using it until you bring your tax burden down to 0, right? And it's, you can't have a negative tax burden. The U.S. government will not pay you. Well, there's the welfare, there's other different things, but the U.S. government is not going to pay you for losing money on your taxes. So it's like if you can bring your tax burden down to 0, which is a pretty great result, and you have extra, you can keep rolling that forward. The way that I see cost segregation be particularly helpful is when people are making a lot of moves, right? So like especially if someone knows that they're going to have a big tax burden and high income, and they know early enough in the tax year that they can choose to purchase a property specifically for the ability to do a cost segregation on it and balance out and lower that taxable income, that can be really powerful. I'd say as a real estate agent, the trick is trying to get ahead of this stuff because all the agents in the room know that we get a lot of calls on November 31st that are like, yo, I need to buy a short-term rental before the end of the year, but it's got to be a smoking deal. Like it needs a cash flow. And I'm like, dude, we've got like 3 days to find this. It's not going to be a smoking deal. Either you buy the first thing that comes up or we're not buying it. So a lot of this has to do with just like the 1031 exchange, right? The faster you have to turn this thing around, the more likely that you have to make sacrifices on the quality of the asset. So if you're able to plan in advance and in April realize that you need to buy a property, you can actually get both a high quality asset and get the tax savings versus doing a scramble in December. You're probably going to need to take whatever asset you can get your hands on if you want the tax savings. So that's the goal here. And it's March, so this is great. We're ahead of schedule.
Speaking about the timing within the calendar year for that tax year, and running a cost segregation study within that year, is it, and also having the short-term rental as the active income with the material participation. If say you don't find a property between first of the year and June, is it still, did you lose that 6 months of offset for taxes? And is it justified then 6 months where you do have that active income participation? Does that make sense?
Is the question? I think I kind of understood the question, but my understanding is, so you already have material participation before?
So it's really just about timing. So
Yeah.
if say it's December and you just buy a property, you only have a month to recoup any of that offset active income. Is it that much more beneficial to have the full year, or it matters less because there's just cost segregation and that could offset your taxable income over the course of the years?
Nav can correct me, but really the only timing consideration, assuming it's within a certain tax year that I'm aware of, is that you need to create the material participation. So if it's the asset that you're using to materially participate, you have to buy it early enough in the year that you can then materially participate, right? If you close on December 31st, you're not going to get 100 hours on the property.
Okay, so it's that 100 hours.
But if you already have the status and you're buying a property, that's a little bit different, right? You could close on December 30th and do your cost segregation on the 31st because you're applying it to the tax year, right? So it doesn't matter when you do the cost segregation, it's applying to the entire tax year. And it also doesn't matter whether you've owned the property for a day or 365 days, it can apply, right? So you're not deducting or prorating the tax impact. If you just bought the property in December, you're taking the full benefit right in that tax year. Yeah.
Yeah.
Cool. I got a sticker on that one. Yeah.
If you bought a property that does not cash flow very well for $1 million, but the land is very cheap, and you take a massive deduction, and then you sold that into, like you take the deduction and you 1031 into something that the land is very expensive and the cash flow is a lot better. Is that some weird transitional loophole thing where you can take a massive loss? If you just bought the second one, your loss would be much less because the land is like well. Is there any way to make that work?
No, I don't think so.
But you have the right idea, right? If you do
Yeah.
a big cost segregation, if you depreciate a very high building value asset and then you sell it, you 1031, you're rolling that tax burden into the next asset. So it doesn't really matter the building value versus the land value. An interesting question is, can you owe unlimited taxes on a property? Like let's say that that Daniel has like 600K in depreciation on that $1 million asset.
Yeah.
And then he buys another $1 million asset. He takes that whole depreciation, he rolls it into the next one. So he owes 600 grand on his taxes or whatever, but it's rolled in the next property. Can you do another cost segregation? Just keep stacking on the tax burden?
Yeah. Yeah. So like,
How high can he go?
it depends on your level of threshold, right? So yeah, let's say if you 1031 into a new property, you can run a cost segregation again and accumulate those losses as well. So
Is your new cost basis million less 600 because you've rolled 600 into it?
yeah, so it all depends on the 1031 exchange, right? So whatever your basis was in the old property gets rolled forward into the newer property. But that's not to say so if you bought a new property, your building basis might be lower, but your 5, 7, 15-year assets might be higher than what the previous property was. So it all just depends at that point.
Can we depreciate more than the value of the property?
No.
Okay.
Yeah.
So even if we kept doing 1031 exchanges, if the property's worth $1 million, we can't depreciate more than $1 million on it. Okay, because we're rolling. Okay.
So there is another thing, all those things to add to it. I've been hearing a lot about bonus depreciation that got kicked in last year. Isn't it that if you take bonus depreciation on top of cost segregation, on top of 1031 exchange, then you take everything all at once? Or you still have to go 3 year, 5 years, 7 years, or 15 years?
Yeah, so bonus depreciation is the benefit of a cost segregation. So a cost segregation allows you to break down your property into 5, 7, 15 to claim that bonus, right? So when you go and 1030, so you accumulate all those losses, you 1031 into a newer asset, you can theoretically do another cost segregation and then still be able to claim bonus on
The full amount.
the full amount, because the building basis will go down depending on how much depreciation you used and everything like that. But you would be able to get another bonus, not another, but you will be able to get bonus as well on the newer property.
Michael, if you have a long-term rental for a few years and you've depreciated some of the traditional depreciation schedule and then you change it to a long-term, can you reset or do a cost seg at that point, say like 5 years later? You do a cost seg and change the depreciation and at that point take a bonus depreciation?
One more time?
So like if you have a long-term rental for say like 5 years and then you decide to change it to a short-term rental, but you started depreciating like with a normal 27.5 year, can you change your depreciation to a cost seg study?
it wouldn't change whether it's a short-term or a long-term rental, but your status could change because you now have a short-term rental and you can get material participation. So it's not that short-term rental and long-term rentals have different depreciation schedules. It's that by doing a bonus depreciation or cost segregation, you can front load the depreciation schedule regardless of the type of asset. And then depending on the type of asset, there's also a path forward to getting this status that says, hey, now you can take that depreciation against your active income, right? So it's kind of two questions, right? It's what is the depreciation? And then it's, do I have this special sticker on my shirt that says that I can take it against my active income? Or do I not have the sticker, in which case I'm stuck just taking it against my rental income?
Right. So like after the 5 years, if you change it to a short-term rental, then you get the sticker, even though you started as a long-term rental, then you change it and then you take it as an active loss.
Yeah. And so kind of to your example, like let's say the long term turns into a short term after 5 years, you won't be able to get bonus on that first 5 years, right? But the 7, 15, you would be able to get something over there. Yeah.
Just to follow up on that, so like you just need the status to claim this, to claim the bonus depreciation, right? So, or to do the cost setting. Like the fact that it's a short-term rental means that you can accumulate that status. It's not the type of rental. It's not that it's a short-term or long-term. Is that correct?
So for material, for short-term, you do need material participation, right? Sorry, one more time on the question.
Yeah, I think I'm just trying to understand. Like, you need to have material participation in order to claim this depreciation, right? But it's not. It doesn't like. To get that status, you need to have a short-term rental. But could you also do that with a long-term rental if you have status from the short-term rental?
No.
Okay.
But, and the reason that oftentimes we talk about REAPs and material participation when we're talking about bonus depreciation is just because the fact that rentals don't actually make that much money and there's a lot of deductions without depreciation and then you tack depreciation on top. The main reason that we talk about this so much with lowering your W-2 income is because most of us don't actually pay any tax on our rental property income already without doing like anything fancy, just by actually tracking our expenses and taking the standard 29 and a half years?
27.
27 and a half years. 27 and a half year depreciation schedule. We're paying little to no tax on most rentals anyway. So it's not that you don't get a benefit from front-loading depreciation if you don't have the status. It's that you might not need to because you probably aren't really paying that much taxes anyway, but you probably are paying taxes on your actual active income. So that's the target, right, that most people are painting on their tax situation. It isn't that like, oh, I want to pay less taxes on my rental properties. It's I want to pay less taxes on my flips, on my W-2 income, on my business, right? So that's why the participation is such an important part of that equation.
And outside of the short-term rental loophole or reps, are there any other hacks to do that?
Is there a third path?
Unfortunately not. Those are the two main paths to move your real estate from passive to active, unfortunately.
So what's reps? Can we talk just briefly, since I think it applies to less of us, but what the reps status means?
Yeah, so essentially, kind of like short-term rentals, the short-term rental loophole. So not only do you have to meet material participation, but you also need 750 hours. And on top of that, more than half of your working time needs to be in real estate. So that essentially means for most of us that has we have W-2 jobs or we have another business on the side, we wouldn't be able to claim that status. Essentially, our full-time job needs to be in real estate in order to be able to claim the reps.
Yeah.
So can I ask a question with that 750? Can I do 500 on my own real estate and then help somebody out with cold calling and then go clean an Airbnb? It's all real estate, but it's not my real estate. Do those hours count for my 750? Or have to be just on mine?
So those hours have to be just on your real estate. So for example, if you're brokering deals, construction, fix and flips, you're managing your own properties, anything like that, the hours you do for somebody else, those won't count.
It's really interesting. how many people come up to me and the team and have like no real estate at all and are like, I need to get reps or I need to get like material participation. And then, I mean, it's a long road to get to the point where you have a portfolio, but when you have a portfolio and you talk to your CPA, they're like, oh yeah, you're good. Don't worry about it. Like, yeah, you've got it. So there are shortcuts. The short-term rental loophole is the most notable shortcut. But the long cut is you just own a lot of rental real estate, in which case that 750 hours, instead of trying to figure out a way that you can suggest that you spent that long on a single property because you're the least efficient landlord in the history of all landlording, maybe you should buy 3 or 4 and then spend like a regular amount of time. I know that that's like farther out in advance, and now we're talking about long-term planning, and that's not as fun as saving a bunch of money on your taxes this year, but that is a viable path forward. And if it feels like you're stretching to fit a square peg into a round hole with this, that may be the path that you should pursue, right?
Yeah, exactly.
Yeah.
What if you hire property managers for all those properties?
So I do have property managers for my long terms, and I don't have them for my short terms. Another kind of just real estate strategy point is that it's much easier to hire property managers for long terms than short terms for multiple reasons. One reason is that the going rate for property management for a long-term rental is 5 to 11%, depending on your portfolio size and what the manager charges. Whereas the going rate for short-term rental management is 20 to 40%. Also, Airbnb is a winner-take-all economy. It has shifted from a hotel replacement to a very like curated experience for a lot of people, and it's gotten highly competitive. So the adage is true that no one cares about your property the way you do. And although you can do well with a property manager, property managers are exceptional at creating standardized products, right? They are great at building processes, and they have volume so they can build systems. They're not great at making something stand out. You really have to have a passion for design and a passion for guest experience to do that. So there's 2 pieces, right? One is that a lot of people are buying short-term rentals for the tax benefits. And once you hire a manager, you might not get those tax benefits. The other piece is that if you're buying short-term rentals, if you're starting this hospitality business and you want nothing to do with it and you want to hand it off to a manager, like, should you even be buying short-term rentals in the first place? If you want something passive, like, is long-term rentals a better approach for you? So I'm really skeptical of people that want to buy short-term rentals and they tell me they just want to hand them off to a property manager immediately, because I just don't think it's the right strategy for that type of investor. Yeah.
In the long-term planning approach, is there a threshold in which a minimum number of floors you need to have to consider qualifying for rep status?
There's no minimum amount. It's just documenting your hours properly, because reps is not a big red flag, but it can be a red flag depending on your tax situation. But if you're able to document all of your hours properly, even if you only have one door, you can still claim reps. Yeah.
On that, I think you said some elements earlier on the hours and the traffic. Researching properties, if we are very specific, we actually including the property, if you take specific properties count as opposed to researching properties. To my understanding, that if we are specific enough and we do all this, we can count against it. Is that correct?
Yeah, depending on the research and how involved you are, you can count some of those hours. Yeah.
Okay, I got another question. Can you study for your real estate license or GC license and count those hours of testing in that 750?
I don't think so. I'll have to double check on the rules on that, but I think you have to be actively participating in real estate, not like, trying to get your license or anything. But I would have to double check. I don't know the full answer to that.
Yeah, and to clarify, someone like me that has 11 rental properties and is also a full-time real estate agent, the reason that I have rep status is the 11 rental properties, not the full-time agent status. If I had no rentals, I would have no shot at being, or even one rental, I would have no shot at being reps. So it has less to do with working in real estate, more to do with working in your portfolio in real estate. So I think that's the most common misconception I see, is that people just assume that like agents, lenders, contractors are reps. But in reality, it's the portfolio, not the client work. Anything I do for my clients is not going to count as hours.
I see with the level, even if you have property managers, you can say, you know, I'm managing the property manager. That becomes convincing.
Yeah. Yeah.
So it has nothing to do with brokering, you know, it's just
Nothing to do with brokering
your own
deals.
property.
Yeah. Although they do play exceptionally well together, right? The best businesses to take advantage of bonus depreciation, reps, cost segregation, material participation are either high-paying tech jobs or entrepreneurship where you have a high income, right? So I do think, despite the fact that being an agent does not help me get reps, being an agent and having reps is a killer combo, because I can lower that active agent income with my rental properties.
So if you're a W-2 employee, and kind of back to the short-term rental, let's say you're doing a HouseHack, you self-manage a short-term rental in part of your house, fully separate for the entire year. Would that count towards that short-term rental loophole, or does it have to be outside of your primary residence?
No, that can definitely count. But let's say if you do end up getting some sort of cost segregation or anything on that, you would essentially have to count the square footage of the area that you live in and then the area that the B&B is in. And then depending on that, you'll be able to take some sort of depreciation on it. But you are able to take material participation, assuming you're actively involved.
Say if you buy 3 Airbnbs in a year, would you recommend, and maybe with like 2 of them you max out, or you're active, active W2 write-off, would you recommend you take the depreciation for 3 on the year 1 and then you just like carry it over, or do you wait to, kind of stack it over years?
Yeah, good question.
Yeah, that's a great question. I think I hate saying this, but it all kind of depends on your goals and everything like that too. So I guess if you want to do a cost segregation on all 3 and just front load the depreciation, by all means go and do it, assuming you're actively participating. Because again, all of those losses just kind of get rolled forward. So even if you don't use them in year 1, you can use them in year 2, year 3, year 4, whatever it is. So
you would recommend doing it every year 1 and then you just like carry it over?
Yeah, then you can just kind of carry it over.
But correct me if I'm wrong, Nav, I would have to continue to materially participate or have rep status. Otherwise, those depreciation losses are only applicable to my rental portfolio, right? Do I have to keep it going?
So there's another way to look at it. So what I've seen is somebody will buy a property, let's say November, they'll run a cost segregation, they get the material participation. Maybe like 2 years down the line, they'll change it to a long-term rental. So all the losses you've essentially accumulated, they still remain, you can still offset it against your W-2, but once it turns into a long-term rental, all of the losses at that point just become passive.
Yeah. We talked a lot about reps, short-term rental deduction, all that stuff. We're running low on time, and we've got time for a few more questions. So I'm going to maybe turn it to Nav and see if there's a couple other topics that he feels are really applicable to our audience, and then also turn it back for questions one more time. Because this is clearly like the meat and potatoes of this conversation. It's what everyone wants to talk about, but I feel like there might be a couple other things worth covering. So I'll give Nav a little space to talk about something else for once.
Yeah, I mean, the biggest thing for me is like having your books. Nobody really wants to talk about this, but having your books in order and having the proper documentation is a big thing. I've seen individuals that'll come to me and, they have their personal expenses and their business expenses all in one QuickBooks or whatever it is. And if the IRS ever comes after you, they can essentially go after your personal assets as well. So it's better to keep everything neat and clean, having your business cards or whatever it is under your business name. And then secondly, documentation is a big one. So if you do want to claim reps or material participation, or even the 7 days or less for your Airbnb, make sure you document it, because when the IRS comes to you and you can provide those documents in a timely manner, a lot of the times, you'll be good on your audit. So,
yeah. Yeah, this is huge too, because I ended up for years paying a ton of money to do my taxes once I hired a tax person, because my accounts were messy. And there was a lot of phone calls and a lot of kind of piecing it together. And I'm sure we missed deductions because we spent a lot of time just figuring out what was happening and a lot less time doing tax strategy. So that's big. If you have a property manager too, oftentimes they provide some kind of like accounting services. It works if you actually run things through your property manager. So one thing to keep in mind is that if you have a property manager and you're like paying stuff out of pocket on the property, you should have the property manager reimburse you or somehow get it into the property manager's books, because they are running books for you. And those books are only valuable if they're your actual books. What I see a lot and what I've done before in property management is I have like a whole list of expenses outside of the property manager's expenses, and then tax time you have to like kind of combine them, which is not the most efficient way to run things.
Yeah.
We have time for a couple more questions generally. Does anyone else have any general tax questions or general strategy questions that they want to get out there?
So I have a long-term rental. If I create, but everything's under my name right now. If I were to create an LLC to be like a property management LLC or side business, can I put it, say, like car and office space to like that business, and then like do write-offs, as a property management business, as opposed to like keeping that, just running things under my name? And that's a little different flavor, I know, than what we're talking about.
Yeah, no, that's a great question. So I think I would highly encourage everyone to not have their property under their personal name. Just put it under an LLC. And you don't even need like a holding company or a management company or anything like that. Just have it under an LLC. So if the tenant ever sues you or anything like that, they can only go after assets under that LLC. They can't really go after your personal assets. So even having each individual property in a LLC can go a long way. So,
but then to like writing off expenses to like a car, or other things, like, can I put those under that? I mean, it wouldn't be like an LLC for the property itself, but it would be like an LLC or like a company, like a property management company,
Yeah, so essentially you have to run your rentals. Yeah, so if you have, let's say, a home office, it depends what you're using it for. So like, for example, if you want to use it for your property management business, yes, you can do that. And then for your mileage too, you can use certain mileage to between your properties or whatever it is, but you can add those deductions for sure.
Yeah, it's definitely easier to Diego's point. It's easier to manage your tax situation when you have a business, whether it's a rental property business or an actual business, because there's just so many more levers you can pull. If you are a W-2 earner, your taxes are getting withheld from your paycheck automatically, and there's a lot fewer levers you can pull. One of the main downsides of being a W-2 earner is that your employer is taking the tax deductions for your expenses, not you. One of the main upsides is that you make money whether your employer makes money or not, right? So as with a lot of things in investing in life, it's a risk off, risk on kind of situation. Is it riskier to be an entrepreneur than a W-2 employee? Potentially. I don't know. Might be changing soon. But a lot of people see it as riskier, but you get compensated for that risk by taking those extra deductions. So there's no right answer for anyone's situation. One of the reasons why I invited Nav on, me and Tyler invited Nav on, and one of the reasons why I think these tax conversations are so helpful is that the answer of it depends, although frustrating, is the answer 99.9% of the time. And the it depends really just means that it's not a one size fit all situation. So I'd encourage people that if they don't have an accountant or someone that they's helping with their taxes, to explore that option. I personally got help with my taxes once I got to 3 properties. I think I definitely could have done it earlier, but obviously like TurboTax and all these automated solutions are a decent option, especially if your situation's not that complicated. But if it's something that you feel like you have a lot of questions about, and if it's something that you feel like you're struggling with, I definitely encourage you to reach out to NAV, reach out to other tax planners, CPAs, accountants, and just start that conversation and see if working together is a good fit, because it does depend. And it's hard to cover all these topics, right? We got through 2. I've got a list of like 10 that we were going to talk about. We got through 2 on this conversation because it's so complex. It's so unbelievably complex. So with that, yeah, I'll send it out. So 2 things. One, I'll share the list of questions, and then Nav and his wife Jazz also put together a package of resources for us to walk away with after this meeting. I think they're going to put the package by the validation center and the check-in. So definitely grab one of those packages on your way out. I'll also get a digital copy of it and send it out over email to everyone afterwards, so you've got something to walk away with, as well as Nav's contact info. We're gonna be hanging out for a little bit afterwards, so feel free to keep asking questions. But I'm gonna I'm gonna put a cap on the questions for now. But everyone, please give a great round of applause to Nav. And we're here for another half hour. Please enjoy. Keep eating, drinking, hanging out. Thanks for coming, y'all.
Thank you.